And of course, with inflation, we will return inflation to 2%. And that won't be, so I don't see the stag or the inflation, actually.
So that's our Powell words this last Wednesday during last FOMC. Basically, I don't see the stag or deflation, meaning he's not seeing any stagflation coming in the next days, in the next weeks, next years, even. Well, that's his answers to one of the journalists that asked about the famous stagflation that some people are talking about. Is actually a real hypothesis. We'll study this hypothesis in a long video, but for today, as usual, let's first jump in our weekly datas. We'll be starting with our usual bonds with first the DXY, where we are now at 105, with this week a minus 0.5%. The VIX took a bit of a downtrend with a minus 12% this week, standing at 13.5. So if you remember, we had kind of a spike basically at the mid-April where we touched the almost the 20 point threshold, where now we are back at the 13.5. So most of it has been due to the confidence Powell gave to the market, being very dovish. So about the bonds we've seen on the 2-year, minus 3.4% this week, standing at 4.8. On the 10 years, we are at 4.9 with a 4.5, sorry, with a minus 3% this week. And the 30-year took a minus 2% this week, standing at 4.67. About the S&P, we are now back above the 5100, standing at 51.27 at last closing, with a plus 0.27% this week. We started down until the 1st of May, which was the FOMC day, and we've seen kind of a rally that was retraced, and then back on Friday. Actually, we had a big opening. Friday opening was way higher than the closing. You see the gap. We closed basically at 50.60 and opened around the 51.10. So that was basically the main gap on Friday. And the gold, it's still at 2300. Going deeper in the S&P, like I've mentioned, we've seen quite flat here, but still a green candle. We remember last week was a very bullish week with, if we take last week, 2.2%. And if we take both last 2 weeks, we are now at 2.7% since the bottom we had at the end of around the 20th of on the 19th of April. That was basically the 3 weeks from our all-time high. That was we took a 5.5% retracement, and we are now back close to our all-time high that was in April, end of March, sorry, where it's 53.60 points. On the US 10-year Treasury bonds, we are now at 4.5, like I've mentioned before, with a red candle for this week. So basically, we've seen Powell giving confidence that the market would not have to increase rates at all, and even the forecast is going as scheduled, as he could say. So this week was a minus 3% on the 10-year, though. That's quite an important movement. So we'll definitely be looking at next data on the bonds. We remember it's the director of the market where there is the most liquidity, and liquidity, it's the market fuel. About last week, news, mainly like we've been talking about FOMC that was on Wednesday, we should remember that it was not a big FOMC. Let's say when I'm saying big FOMC, I'm just saying it was not a FOMC with projections. We have some projections on some FOMCs. So if we look here, just to remember when will be the next projections, it's in June. The last one was in March, like you can see projection materials here. And this FOMC, we didn't basically every two FOMC meetings we get a projection. So next FOMC on the 12th of June will be definitely providing interesting data, because they would have to provide projection materials looking at next coming years. We'll see how they adjust based on their previous projections that was back in May. On the next news past week, we had the JOLTS numbers, basically mainly the jobs openings, with the earnings on Friday and the NFP that came at 175 while forecasted at 240. So that's below the forecast. Next week, we don't have that much data. Actually, nothing very important. It's quite a flat week. The waiting point will be the week after that, on the Tuesday 14, where actually Wednesday 15, as you can see here, where we get CPI data. And if you remember, last data we got in April about March CPI. So in May, we'll get April CPI, was actually quite high. We got 3.5% actual number, keeping us above the 3%, while the March 3.2 and the February 3.1 was giving some hope to breach the 3% threshold, if I can say. So that would be in 2 weeks. Next week, not that much data to be objective on the calendar. About the rates, basically June meeting is no surprise. We'll see no cuts. Now it's a 92% chance that we see no cuts for the next FOMC. We are actually quite sure about that. Even in July, if we look forward, it's only 63% here that we are seeing about no change probabilities. Still, it's very unlikely to happen. So on my side, I would go higher than that. But well, that's what the market is saying. In September, we have 30% chance of no change, with basically 70% chance of 1 or 2 cuts. And in November, the market is forecasting 20% chance of no change, with basically 80% chance of no change with 1 to 3 cuts. And in December, that would be quite the same, 90% chance of ease, with, as you can see, standing here, we would see 1, 2, or 3 cuts. But the highest probability we actually have now, if you sum up 36 plus 30 plus 10, that leads you like around 75. So you got 3 out of 4, basically 35% chance of only 1 or 2 cuts before the end of the year, putting away the 3 cuts hypothesis, with roughly only 20%, 25% chance for this hypothesis. We ourselves think the cuts might come after the election. So the 30% chance of no cut by September seems pretty reasonable. If we had to bet, we would bet on that one. For the extra data that I wanted to mention, congratulations to the federal US government that is now paying more than $1 trillion in interest payments. So you see the data has been updated in April 25th last month. So it's about 10 days ago. And we are now above the trillion in interest payments for the federal government. So if we look, we basically doubled this number from the 500 billion we were at in 2020 to the now $1 trillion in interest payments. So in the time of 4 years from 2020 to 2024, interest payments doubled, meaning that if we have to increase rates at the same pace that the Fed has been doing these last months, we could definitely see something doubling again, going from 1 trillion to 2 trillion. And after that, fundamentally, it starts to be very problematic, because when you're starting to pay 1 trillion, you can even 2 trillion interest payments per year. Even if you're the United States, you will come to a point where financial laws will make you come back to reality, if I can say. Just wanted to touch base on those numbers. We have old updates, but that are Q4 updates of 2023. We get Q1 data in May. So just to look up before the update in about 3 weeks from now, 2 weeks or 3 weeks from now, on the delinquency rate on all loans, we are at 1.4%. So you can see we were in Q3 at 1.3, and in Q2 2023 we were at 1.2, and in Q4 2022 1.2 also, where we basically bottomed at 1.2, and now we are starting back since actually Q3 2023. We've been increasing by 0.1% per quarter, now standing at 1.4. Will we see 1.5 in Q1 2024 or more than that? We'll see the data by the end of the month. About this one, the delinquency rate on credit card loans, we are at 7.8. So just, yeah, to give some perspective, it's an all-time high since the data has been tracked in the 90s. So it's been actually 30 years that we've never seen delinquency rates on credit card loans that was above 7.2. That's a level we breached at Q2 2023 last year. We are now standing at 7.8. We'll see next quarter, so Q1 2024, what will be the number, if we are above the 8% or not. And finally, just as I already have mentioned, the velocity of M2 money stock. So just a quick reminder, the velocity of money is the frequency at which 1 unit of currency is used to purchase domestically, produce goods and services within a given time period. So basically, it's like it's written here. In other words, it's the number of times $1 is spent to buy goods and services per unit of time. If the velocity of money is increasing, then more transactions are occurring between individuals in an economy. As you're looking on this chart, we've touched a bottom at the 2020 crisis, and we've been going up since that time. So we are now at 1.35, and we can see it's almost the level of pre-pandemic. We are almost at pre-pandemic levels, still below them, where we were around 1.5 actually. To give some perspective, in 2008 crisis, we were at 2, and we basically went to the 1.7 with the crisis. And now we are at 1.3, 1.35. So if we forecast basically a reduction of transactions in the economy, we have less margin than during all previous crises. So basically, we are definitely not in the same situation the saying that crisis is part of capitalism, it's basically thinking that the crises are kind of healthy. But looking at this chart, we can understand that at a point when we reach one, when the money is not moving anymore, when there is no more transactions, there's no coming back. I mean, if there's no more fuel in the engine, it will not start back, in the sense that previous crisis we recovered because the flow of money was still going around, and now with a 135% velocity, we have way less margin. Okay, so if we lose like we've lost in the 2008, let's say 0.2 points, that will lead us to 0 to 1.1 at around the 2020 situation, where there were almost no transactions. So we have way less margin. We'll see this data evolve, of course, with the situation in the market. Basically, it will be more like a consequence, this velocity chart, but it's always interesting to have a look to it. That was all data I wanted to touch base with you this week. We should talk on next weekend, and I wish you all an amazing week.